So now let's understand the different types of financial market. Financial market can be broadly categorized into three segments. First would be your securities market, second derivatives market, and third your foreign exchange market. In securities market, it can be further classified into capital market and money market depending on the maturity of the financial investment. Next would be derivative market where we do not deal with the prices of our asset for the current duration, but we deal with the prices of the asset in future. That covers our interest and forex and also for commodity. We will be going through these markets in detail in our future videos. The third is your forex market where the companies, since into this era of globalization, they would be needing funds from globally. Let's say there are companies in India, basically the IT companies or BPO companies which are in India, they get their funds from US, UK, Australia, Singapore and different parts of the world. Now each of them will be coming into different currencies, but we need to put them into one common currency that may be INR in case of India. Hence we need a marketplace which makes this exchange possible. There comes the forex market, and also forex market is the biggest business in the world. Now let's understand capital market, our topic for the day. So capital market is a subsegment of securities market. So basically in securities market we are dealing with a particular investment where maturity is more than 365 days or more than 1 year. It could be 10 years or 20 years or 5 years. So any asset which has the value or the life more than 1 year will be falling under capital market. And it helps both corporates as well as government to raise capital. In case of corporates, both private and public sectors would be raising fund by using capital market. And as I told you, it deals with the long-term securities, so it can be long-term debts or equity securities. Now let's understand how capital market has worked or grown over the period. Right, so let's say in 1989 capital market was somewhere around 12 trillion US dollars. It has definitely rose till 1999 and then there was a decline in 2001. This was a period for dot-com bubble. Then again it rose, and this was the period when there was a major decline which was due to subprime crisis which happened in the year 2008-2009, and then there was again a growth and a ripple effect of subprime crisis which we are still seeing in the world. So if we avoid this cyclical variations that has happened, and if we go with the trend right from 12 trillion US dollars from the year 1989, it has rose somewhere around to 47 or 48 trillion dollars by 2011, which makes it a very huge growth and has a great future for the investors to learn about it and make a careful investment in capital market. Now let's understand the different trading modes that we have in capital market. The first one is your OTC, that is over the counter, where two parties come together, they sign an agreement, they put their terms and conditions. So it's a non-standardized contract that happens between two parties. So if we are dealing with a particular contract or particular instrument where there is no standardization, no marketability, it's just between two parties, so that kind of trading mechanism will be known as OTC or over the counter. The second one is very famous, that is your stock exchange. We must have heard about Bombay Stock Exchange or National Stock Exchange or New York Stock Exchange, where the buyers and sellers do not enter into a contract directly, but they buy or sell from the market. That kind of trading mechanism is your stock exchanges. Now, very important question, why people would invest? 100 rupees note under your pillow or in your pocket, maybe for 1 year or 10 years, is not going to make any difference. It still remains to be 100 rupees. But what we need to understand from the concept of time value of money is that the value of money today is more than the value of the money in future. That means in order to secure the value of money that you have, it is no more a choice that you are going to save money, but the choice now is that apart from saving, you also need to invest money into the appropriate assets depending on your risk and your expected return, right? So that comes to bring us to next topic, that is your risk return trade-off. Now each one of us have a different expected return that we expect from the market, or we have got different risk appetite. So there should be a balance drawn between our risk and return. That part is called risk return trade-off, and this will be the basis of your choice of product in the capital market. Next is diversification. Now capital market not only provides you the opportunity to invest in shares, it also provides you the opportunity to invest in debts, maybe gold or different other asset classes. So hence capital market is the appropriate choice in case you want to diversify your investment. Now that again brings us to the next topic, that is allocation of wealth across different assets. That's how your portfolio is created. Now every asset comes with different expected return and different risk which it carries, right? So you need to create a balance between there. Hence you have different asset categories where you can allocate your wealth. Now you cannot be an investor just who invests on the advices of your friends or family members, but you should be an investor who can do a calculation for your own, who can understand what is the intrinsic value of the asset where you are going to make the investment. We will see this in the future videos. So that brings us to stock valuation methods. And you need to keep on checking the performance of your portfolio from time to time. This is your evaluation of portfolio performance. Now let's understand IPO. That's how the investment in stock market starts with IPO. So IPO falls into a primary market. That's a subsegment of capital market. Capital market can be categorized into primary market and secondary market, which brings us to IPO. IPO means initial public offering. This means that the securities are issued for the first time by the company. The return or the money that they draw from the sale of the securities comes directly to the company, and investment bank would be acting as the underwriters, which gives them the assurance, to the startups or the existing companies that don't worry, we will make sure that all your shares are subscribed. So it is the only time the company is going to receive the money, that is from the IPO. For all the stock exchanges, the trading that happens, the money does not come to the company, but the money goes to the person who holds the shares from IPO. Now this is called primary market, as we have discussed. Now since we have understood what is IPO, the next question would be, what is an FPO? So FPO means follow-on public offering. It's not that the company has issued the share once, it cannot issue the share in future. In case the company wants to expand its business, it can definitely issue more shares in future. Those issue of shares in future again by the company will be known as follow-on public offering.